Hey everyone, and welcome. Today, we're going to build a professional framework for trading. We're moving beyond just guesswork and really getting into what matters, understanding risk, reward, and your real mathematical edge. So let's dive right in. All right, before we get into the good stuff, you know the drill. This is all for educational purposes. It is not financial advice. Please use this as a tool to help you learn, but always do your own research before making any decisions. So, right off the bat, let me ask you a question. Is a 60% win rate good? I mean, it sounds pretty great, right? But the real answer? Well, it's not as simple as you might think. And by the end of this, you're going to learn about the one number that really defines a winning strategy. So, here's what we've got on tap. First up, we're going to find a universal yardstick you can use for every single trade. Then, we'll use that to figure out what your real edge is. After that, we'll walk through a trade from start to finish. And finally, we'll cover some common money pits you definitely want to avoid. Okay, let's kick things off with the absolute foundation for any serious trader. This is your yardstick. It's the one unit of measurement that changes everything, and it's called the R multiple. So what is it? Well, an R multiple, or we can just call it R, is simply the amount you decide to risk on one trade. It's defined by the space between where you get in, your entry, and where you get out if you're wrong, your stop loss. Just think of R as one single unit of your risk. Okay, let's put some real numbers to this to make it super clear. Imagine you buy a stock at $100. You decide that if it drops to 95, you're out. That $5 difference, that's your initial risk. That is your 1R. Simple, right? That $5 is your building block for this entire trade. And this right here is where the magic happens. When we use R, we can standardize everything. So a winning trade that hits $110, that's a +2R win. You made twice what you risked. If it goes against you and hits your stop at 95, that's a -1R loss. Suddenly, you're comparing apples to apples, whether you're trading a $10 stock or a $1,000 stock. All right, so now that we have our yardstick, our R, we can start using it to measure something way more important than a simple win rate. We're talking about your system's expectancy. This is how you find out if you actually have a mathematical edge in the markets. Expectancy, sometimes called EV, is basically the average amount you can expect to make or lose per trade over a long series of trades. If it's positive, you've got a mathematical edge. Simple as that. But if it's negative, well, you could be heading for trouble, even if it feels like you're winning a lot. And here's the math that brings it all together. Don't worry, it's pretty straightforward. Your expectancy is your win percentage times your average win minus your loss percentage times your average loss. See, it's a tug of war. A high win rate is awesome, but it can be completely wiped out if your average losses are too big. Both sides of this equation matter a lot. And this is why we asked that question at the very beginning. Can a 60% win rate lose you money? Oh, you bet it can. If your average losing trade is way bigger than your average winning trade, you can win most of the time and still slowly bleed your account dry. It's not just about how often you win. It's about how much you win when you're right versus how much you lose when you're wrong. Okay, theory is great, but let's make this stuff real. We're going to walk through a trade from A to Z, applying these ideas every step of the way, from the initial plan all the way to the exit. First things first, the plan. And this is crucial. All of this happens before you even think about hitting the buy button. You decide on your maximum cash risk, maybe 1% of your account. Then you figure out your 1R based on your entry and stop. Your position size, that's just your cash risk divided by your 1R. See how that ensures every single trade has the exact same planned impact if it fails? Step 2, let's place the orders. You set your entry, you place your stop loss at that -1R level, and you set a profit target. Let's say we're aiming for +2R. And here's a pro tip. You link your stop and your target together with something called an OCO, or one cancels the other order. This little trick is a total game changer for staying disciplined. Step 3 is management, while the trade is live. So if things go your way and the price moves up by a full 1R, you've got a fantastic opportunity. You can move your stop loss up to where you got in. What does that do? It basically turns it into a risk-free trade. The worst thing that can happen now is you break even. That's a pretty good feeling, right? And last up, the exit. You know the best part? Because of that OCO order we set up, it's all hands off. It's automated. If the price hits your target, boom, you're out with a profit and the stop order disappears. If it turns around and hits your stop, you're out with a planned loss and the target order is gone. This takes all the emotion, all the second guessing, right out of the equation. Okay, so we've seen how to do it right, but let's talk about how it can go wrong. These are the classic money pits, the common mistakes that you absolutely want to steer clear of. First up, a big one. Confusing R with some fixed dollar amount. It's not. R is unique to every single trade based on your entry and your stop. Second, that siren song of a high win rate without ever checking if your wins are actually bigger than your losses. And third, a sneaky one. Thinking a stop loss guarantees you'll get out at that exact price. Look, in really volatile markets, your stop can trigger and you might get filled at a slightly worse price. That's called slippage, and you've got to account for it.
All right, knowing what not to do is great, but having a solid process is even better. So we're going to wrap all this up into a super simple, actionable checklist you can use to plan out your very next trade.
Here we go. Just run through these steps before you even think about putting on a trade. 1. What's your reason, your thesis? 2. What are the key price levels? 3. What's your specific entry trigger? 4. Where's your stop loss? Remember, that defines your 1R. 5. What's your profit target? You should be aiming for at least 2 times your risk, and only then, at the very end, do you calculate your position size. Look, hearing about this stuff is one thing, but to really make it stick, you've got to practice. So, here are a few drills for you. Go back to your journal and calculate the R multiple for your last 5 trades. What was the average? Then try back testing a simple strategy, where you always aim for 2R and risk 1R. And finally, go look at your losing trades on those crazy volatile days. Did you experience any slippage? So I'm going to leave you with this one question. A direct challenge, really. Don't just think about it, actually do it. Open up your trading journal and calculate it. What is the average R multiple of your last 10 trades? Is it positive or is it negative? That number, whatever it is, tells you the real story. It's the truth about whether you have an edge or not. And hey, one last time, just a quick reminder, this was all educational content designed to be a learning aid. It is absolutely not financial advice, and you should always do your own deep research before risking any of your capital. Thanks for tuning in.